Bloomberg Audio Studios.
Podcasts, radio, news.
As we bring you a special conversation now, thanks to our colleague Michael McKee, who's joining us from World Headquarters in New York, and a special conversation with Cleveland Federal Reserve Bank President Loretta Mester. Michael, take it away.
Well, thank you very much, and good afternoon to everybody watching us and listening to us on Bloomberg Television and radio around the world. And I don't know what you say to people on the internet who are watching, listening, whatever, but thank you very much for joining us. This is sort of your farewell tour. You're retiring at the end of the month. So let me ask you, you've been a voter this year to this point. By December, do you think we will see one rate cut, more rate cuts, or no rate cuts?
Well, thanks for inviting me to be here. I mean, we all put in our projections at this meeting that was held this week, and the median projection in the SEP is pretty close to my own projection for the economy. We've made pretty good progress on inflation over the last 2 years. It's still too high. The most recent data that we received, in fact, we got the CPI report on the second day of the meeting, and it was a great gift for my last FOMC meeting to get that report, the good news there. But it still means that there's work to do on inflation to gain confidence that it is on that downward trajectory to 2%. And you know, the unemployment rate has ticked up a little bit over the last couple of months. Certainly, though, if you look overall, the labor market conditions remain healthy, and that's a great thing too. So I think monetary policy right now is well positioned really to ensure that inflation does move back down towards 2% over time and that labor market conditions remain healthy. And that's a good position to be in. And if you look at the SEPs overall, what you see is the modal path of the SEP across participants is that rates will be coming down. The dot plot shows that there was weight on 1, 0, 2, but it'll really depend on how the economy actually evolves. And I think that's going to be the work of the committee going forward, assess incoming information about the economy. Does it change your outlook? Is it consistent with the modal outlook? And as inflation comes down and as inflation expectations, short run, a year ahead, comes down, then it'll be appropriate to reduce that Fed funds rate and remove some of the restrictiveness.
Well, further confidence that you're moving towards the 2% target is almost a cliche now. What does that actually mean? Does it mean you need to see the various inflation indicators keep coming down, even if it's only, say, a tenth? Do you have a level of the year over year rate of inflation that you want to hit? How can people judge what the Fed is going to do, what they're thinking about?
So what my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue. Remember, at the beginning of the year, January inflation was higher. There was some real issues with measurement, residual seasonality in that measure. But then we got 2 more reports that were consistent with, wow, there's not been progress this year. I came into the year not expecting the same degree of progress that we saw over the second half of last year because we did get a lot of help from the improvement in supply conditions, both in the labor market and in product markets, and I didn't expect that to continue. And a lot of the work that the Cleveland Fed does in our Center for Inflation Research suggests that it's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down and normalizing our policy.
So as long as it moves down, it doesn't have to hit a point target.
Yeah, not to me. To my view, it would be that if I continue to see some of these better inflation reports that we got than we got earlier in the year, if that continues, then I'd feel comfortable starting that process of normalizing rates.
Well, you've said what others have said on the Fed, that once the momentum is there, it'll keep going down, so you don't want to wait till you get to 2.
Correct.
So you don't fall below it. But by implication, that means you're going to be starting behind the curve. Inflation will already be heading in that direction. Can you put the brakes on fast enough so that it doesn't go back down into disinflationary territory?
Well, so let's step back from that. I don't know whether we're behind the curve, right? Policy affects the economy with a lag, as we know, long and variable lags. So we've got to make sure that we're going to be taking some of the restrictiveness off before inflation gets to 2%. And so when we're thinking about it, it's really, are we confident it's on the path back to 2%? But then it's a calibration exercise, right? Taking into part both parts of our mandate, right? We want to maintain healthy labor market conditions at the same time ensuring that inflation goes all the way back down to 2%. And so the committee will be calibrating its policy, right, to achieve both parts of its mandate and take into account the risks to both parts of this mandate as it goes forward. So I think that's the way I view it, is that this really is now monetary policy is well positioned no matter which side the risks manifest themselves. And then the work of the committee is to assess those conditions, incoming information, how does it inform your outlook, how does it affect the risks around the outlook, and what is that, the implications for policy. So I think that's what the exercise is going to be going forward.
When you're looking at the outlook for the economy, there's a lot of criticism on Wall Street that the Fed, being data dependent, is always looking at what's happened in the past, perhaps not realizing you're constantly talking with people in your district, with CEOs in your district companies, and getting their views. And I'm wondering how well their views that they're telling you now end up matching up to the data.
So you're exactly right, Michael. The work that we do in the districts is incredibly important because we talk to a number of contacts, business contacts, community development practitioners, labor market representatives. So we have a really good sense of what is really happening in the economy. And right now, what they're telling us is very similar to what's in the data, right? In terms of the labor market, it is easier to hire now than it was a year ago. It is easier to retain workers than it was a year ago. The offers they have to make on wages are lower than they were a year ago. The average for our district expectation for this year is 4%. A year ago was 5%. So that sort of balancing between supply and demand is happening when you talk to businesses about what they're seeing out there. Similarly, there are firms that are telling us that, wow, I wish I had raised my prices higher last year because now it's much harder to raise prices because price pressures and whether the consumers will accept the price increases is coming down. They don't have as much pricing power as they did before. Nonetheless, there's still some. And so that's another indication that, okay, we've done pretty well on inflation getting it down, but we're not all the way back to 2%. And that's going to, again, be something that the committee is going to have to keep assessing. But I would say that what we're hearing from our contacts is very similar to what's in the data. Demand has moderated a bit across firms in our district. There are several firms that say that infrastructure spending and the support from the federal programs they've benefited from it, and they expect to continue to benefit from it. So again, the economy seems to be still on a good, solid, firm stance, and now it's a question of let's get inflation back to 2%. Let's keep those labor markets healthy.
Well, we're going to get a couple more inflation reports, obviously, before the next meeting. Would you say that July is actually a live meeting in play? Would September be the first one?
I mean, I think all meetings are always in play. Again, it's really going to be about what happens in the economy. So rather than thinking calendar time, I think the better approach is to think about how is the economy evolving? Has your confidence been raised that, given the reports that have come in, that inflation is on that sustainable path back to 2%? And I think the committee is going to do that careful analysis and also assessing what's happening in the labor market. We have seen the unemployment rate move up. It's moved up, I think 0.6% since early last year. So again, you've got to assess both parts of the mandate. When we started raising rates, right, we were focused wholly on the inflation part of the mandate because labor markets were strong and inflation was high. Now, right, as inflation has come down, both parts of the mandate now become very important for us to be assessing risk around it. And so I'm confident that the committee will continue to do that as it calibrates its policy rates to the economy as it's evolving and as they expect it to continue to evolve.
You've got a big calendar date in the middle of your meetings that I know you would say doesn't have anything to do with us, the election. But would you say a rate move, if inflation continues to cooperate, is more likely before or after?
I honestly can tell you, and I've gone to a lot of FOMC meetings. Someone told me I went to over 200 FOMC meetings in my career. Not all as a policymaker, of course, as a research director at the Philly Fed. Politics doesn't enter the room. It really is about what can we do with our policy to achieve our dual mandate goals, taking into account what the incoming information is telling you about the outlook for the economy, taking into account what the risk around achieving our dual mandate goals is telling us. And there's nothing about politics that enters these decisions.
Well, it could have an effect next year in the sense that if we got a new president, we'd have new fiscal policies. We've got a lot of problems coming up in Washington next year with the debt ceiling, with budget negotiations, with taxes. How much faith can we put in the dot plot for 2025 and for the forecasts in 2025? It seems like there's so many unknowns that the Fed really can't have any idea what's going to happen.
Well, we do have an idea because we have to do a forecast, right? Whenever you're setting monetary policy, because you know it doesn't affect the economy immediately, it takes some time to play out, you have to think about what's happening with the economy. I think every business does that. They're all assessing what's going to happen to my company, what do I think the environment is. We're doing the same thing. We have a review of where the economy is most likely to go, but we also understand that as you go further out in the horizon, it could evolve differently than our current expectation is, right? It could be that labor markets, deteriorate faster than we're expecting now. That's not my base case, but it's a possibility. It could be that inflation, even though we've gotten a couple of reports, maybe it hangs up there a little bit longer. The research that we do at the Cleveland Fed suggests that it's going to take some time for inflation to come back down, but it is going to come back down. And so that is always true. And the longer time you go out, right, the less certainty there is about things. So, my expectation is that we'll be systematic in how we adjust policy based on what's coming in terms of telling us about where the economy is going and what the risks are. And that's, I think, the way to view this, right? The committee can't be prescient, right? We can't know for sure what's going to happen. But what we can do is we can assess as best we can where the economy is going and those risks and set our policy appropriately. And if information comes in that suggests that, the economy is evolving differently than we might have thought, we'll adjust policy in response to that.
We have about 30 seconds left. One last time for all the people on trading desks who are watching you right now, any forward guidance for Wall Street?
No, but just understand that the committee and the institution at the Fed really does focus on setting policy to achieve our dual mandate goals. We're very committed to doing that. And we're committed to getting price stability again, inflation down to 2%, while maintaining healthy labor markets. And I think that's the key thing for the Wall Street to understand.
Oh, by the way, Cleveland Indians weren't supposed to be any good this year. They're in first place. Is that because of Fed monetary policy?
Oh, of course. That's definitely the cause.
Thank you very much. Loretta Mester, president of the Cleveland Fed for 2 more weeks. Thank you for joining us today here on Bloomberg.